All right, so I want to stand on existing protocols. This training is being anchored by KCP, and by privilege happens to be the managing consultant, and we'll be looking at IFRS 15, revenue contracts with customers. Okay, so we'll be looking at the following. There will be lots of clarifications, discussion, and rub of opinions here. So we'll be looking at the following content: introduction to the standard of revenue. What is the objective of the standard? That's IFRS 15. What is it trying to achieve? Then what is contract? What are the recognition criteria of a contract? What are the conditions for application of IFRS 15? The scope of IFRS 15. Then three other ones that I didn't mention there are how do we measure contract or consideration coming from contract? How do we present? And what are the disclosure requirements, right? Okay, well, let's start with this. Pardon me if I call you Lizzie, right? Not lazy, it's Lizzie. All right, who will help us with the first one? Dash is an agreement between two or more parties that creates enforceable rights and obligations. Dash is an agreement between two or more people that creates enforceable rights and obligations. Can you help us? Anybody? Contract. Okay. Do you disagree? Okay. Dash is the standard on revenue from contracts with customers. FRS 15. All right. Dash is the formal standard on revenue. Please. Then dash is the commencement date of the use of IFRS 15. Can you help us with that? On your own. On your own. When did lease commence? You said it last week. No. 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 2019. No, you said 2018 before. Oh, okay, I didn't get that. That was why we said that, one of the conditions for applying that IFRS, early adoption of IFRS 15, there's now said that you must early adoption of IFRS 16, you must have complied with 15 before you can adopt it. So this one is 1st of January of 2018. You will see it as we go on. Okay, Dash establishes the principle that an entity applies when reporting information about the nature, amounts, timing, and uncertainty of revenue and cash flow from a contract with a customer. Nobody. So if you want to get the answer to it, listen as we go on. So we'll do a brief trace about how we get to where we are on IFRS 15. What have been the position of things before now? In April 2001, the International Accounting Standard Board adopted IAS 11, which is a construction contract, and IAS 18 revenue, both of which had originally been issued by the what? IASQ. Or IASC. What is the correlation between IASC and IASB? Tomiwa? Okay. Oh, really? Mr. K, what's your opinion?
ISC used to be global standard setting body, and then there was a change in constitution. So ISB replaced ISC.
Okay, so what is a version, not to both of you because I mentioned this last week, what is a version of ISB in Nigeria? Madam? So you obviously know that ISB issues the standard, right? What is the Nigerian version, the local standard setting body of the IFRS we are adopting? You're spying it there? Okay, can somebody bail her out? So we mentioned it last week. That is what? FRCN used to be what? Yes. Okay. So we have these two existing standards and they addresses two different issues before now. So the regular revenue other than contracts is being handled by IS 18, and every other revenue arising from construction contracts is being undertaken by IS 11. So in IS 18 replaced a previous version. There was then, as at 1982, we used to have that same IS 18, but it was tagged revenue recognition. Do you understand? So as at the earlier date, 2001, it was amended and simply called revenue, right? Understanding this is very, very important as we go into IFRS 15. So IS 11 replaced part of IS 11 accounting for construction, just like we earlier emphasized in that. We used to have the previous IS 11, which was tagged accounting for construction contracts. Now, when it was repealed in 2001, we then call it what? Construction contract, right? Then in December 2001, the board issued SIC, S-I-C. What is the full meaning of that? Okay, now what is the new name for it? We used SIC in those days when we used to have the whole international version of the standard as IAS. Now that we have IFRS repealing IAS, what is the interpretation committee we have, or interpretation for the standards that we have? IFRIC. Okay. So that's SIC 31, which is on revenue. Because you know that there is, long before now, when we have money, when we have the major means of exchange done in the barter system, right? We say that the advent of money has actually overtaken that. But there are still some transactions that are done in exchange for service, one service for service. So there was then 631 revenue that handled barter transaction involving advertisement services, right? I'm trying to drive home a point, right? So just follow me as we go on. Then in June 2007, I told you, you may jot relevant points that you feel like, but I will definitely share the slides with you. In June 2007, the board issued IFRIC 13, Customer Loyalty Program, right? And what are the issues that gave rise to this? As the board make effort to making relevant amendments in a substantive standard, we notice that the more they seek to amend the loopholes, the more we have more loopholes, right? So as at the last amendment in 2001, there is then the need for you to address the concern, which was not fully addressed in then IS 18. And it is it is in this light. Oftentimes you will have visited SPA and they will give you a particular card, they call it loyalty card. When you reach certain grade points, you can then take anything within that of equivalent value for free. How do you account for it? That was what these seek to address as the lacuna in the then IS 18. Do you understand? Then other versions of those complexity or deficiency we had is what we call warranty. I sold this phone to a client, to a customer for let's say 70K. And I said, provided the phone didn't get spoiled within 2 years, it will be then be deemed to have been sold. But otherwise, any repairs of that nature within 2 years, technical or manufacturing error, bring it back, we'll repair it. We either repair it if it's repairable, or we replace the phone. How do you think all these will be accounted for? Do you understand? So watch as we go on. Because the general perception of most accountants is whenever we render services, whether the entire expected promise has been delivered or otherwise, we just recognize the revenue, bam, and we go on. But most often than not, what is the implication of all of these things we are doing? It has a lot of tax implications. I'm currently addressing a concern. Permit me, I will mention the name of the clients and I will mention the name of the auditor. So what is the concern? The concern is the business, the company they do something similar to lending business. All this digital lending, borrow money, pay with interest and all that. But we then find out that in a particular year, they accrue more than 4 billion as interest. And as much as 3 billion of that 4 billion accrues on impairment, IFRS 9, and write-offs of loans. Do you understand? So we acting as a tax consultant then have a lot of battle to face, to fight with the service. Because then we then look at it. The moment you see any amount on the face of the account as expenses or write-off, that is so material, it becomes, you will have to do a lot of documentation, defense, why that amount should be recognized as an allowable expense. So the question then is, why could you have recognized XYZ as your revenue and you are having write-offs that is even much more than 50% of the revenue? We are still on this matter. It's becoming so serious. So it is in my course of defending that I noticed that not every value that appears as revenue that constitutes fulfillment of consideration for fulfillment of promises made to customers actually in the long run constitutes a revenue, particularly when that amount has not been paid. You understand? Please, if I see anything that you get lost in the process, draw me back. Or sometimes I talk as though I'm talking to my fellow, but I believe true. You shouldn't get confused. You're my fellow accountants, right? So these are some of the issues. Let me give you some of the things that could buttress what's the earlier scenario and the earlier painted. What should I do as the accountant if I render a service? Let's say I'm a furniture person. I constructed this workstation to a client, I delivered it, but I later find out that my supposed customer does not have the capability to pay, maybe because of loss of jobs, wherever. What will I have done, or what am I expected to do? These are some of the issues we have. In my earlier reference, they had accumulated as interest income on those supposed non-performing loans, to the tune of what I earlier mentioned. But these said borrowers could not pay for reason beyond their control, maybe loss of jobs, maybe improper follow-up or whatever. What is the provision of the standard about how to address such concern? Those are one of the things that IFRS 15 seek to address. The second is that, oh, customers has actually paid you for certain services that you have not fulfilled the performance obligation. How are you expected to report it? Taking cognizance of the possible tax implications. The moment you report the revenue line, FRS will be coming to you and say, give us the VAT if that transaction or line item is a vatable income. Do you understand? And in some instances, whoever that is paying you also would have been expected to have deducted the withholding tax. And the said income you have disclosed will also have CIT issues, education tax and the like. In some extreme case, depending on the sector where you work, you then also be exposed to meet that. Right? So what are you, or how are you expected to address all of this, your financial, without any intention? How are we expected to make right presentation, right recognition, right measurement, and right disclosures? Is that clear? So the interpretation was developed by the IFRS Interpretation Committee, the Interpretations Committee, to address the accounting by the entity. Anytime I use the entity here, I'm referring to the reporting company that grants award credits to its customers. You see that as we go on. The interpretation was also originally developed by the Standard Interpretation Committee of the ISC to determine the circumstance in which a seller of advertising service can reliably measure revenue at fair value of advertising service provided in a barter transaction. So if I do an advert in exchange for another service, right? Let's assume you owned an advertisement agency and you needed my service as the external auditor. And I said, okay, I will render the service for you in exchange for you helping me towards publicize my services. How do you recognize it? At what value should I or either party be reporting as the revenue item? Do you understand? So these are some of the things that will be addressed as we go on. In July 2008, the board issued IFRS 15 agreements for the construction of real estate, which is also another typical issue that the existing standard could not totally address, right? The interpretations was developed by the Interpretation Committee to apply to the accounting for revenue and associated expenses by entities that undertake the construction of real estate directly or through subcontractors. You get it? So while we are trying to identify each of these areas is to let you know how robust the existing IFRS 15 is. Do you get it? Because all of these adjustments or amendments or provisions were made by separate of several documents. But IFRS 15 seek to address everything in a single document. So after we finish this, we are not expected to now be making reference to IFRS this, and all of that as far as revenue from construction, contract with customers is concerned. In July 2009, the board issued IFRS 18 again, transfer of assets from customers. So this interpretation was developed by the Interpretation Committee to apply to the accounting for transfer of items of PPE by entities that receive such transfer from their customers. So oftentimes I may also render a service for a customer in exchange for another asset. What value will I report as the consideration for my service? Is it the value, the fair value of the asset, or my real estimate for my service? Do you understand? I hope I'm not alone. Okay, so in September 2015, the board issued effective dates of IFRS 15, which differ the mandatory effective date of IFRS 15 to 1st of January 2018. So the standard we are talking about was not actually issued in 2018. Of course, you know that is not possible. A lot of work has been done before that date, dated September 2015, but the effective date of it was 1st of January 2018, while that of IFRS 16 was 1st of January 2019. Hence, the standard then says that if you have to prepare financial statements of prior periods, right, and you choose to adopt IFRS 16 earlier than its effective date, you must make sure that you are fully complied with IFRS 15. So what are the things we are expected to comply with when you are addressing the concern in IFRS 15? In April 2016, the board issued clarifications to IFRS 15, revenue from contract with customers, clarifying the board's intention when developing some of the requirements in IFRS 15. It's a very robust standard, very, very robust standard. Okay, so I think I duplicated this. I'll just take it from there. These amendments do not change the underlying principle of IFRS 15, but clarify how those principles should be applied and provide additional transitional relief, right? So unlike what we then preach under IAS 18 as the condition for recognizing revenue as at the point when you have transferred your risk and reward arising from that promised service or promised good or services. Now IFRS 15 shifted but did not deviate totally from that transfer of risk and reward. We are still dwelling on that, and we'll make reference to it when we get there. But it's just that it throws more light on how can we then establish what led to the intention to transfer risk and reward, and what will be the consideration. How do we value the consideration? Is that clear? So in May 2017, don't forget we had earlier set the effective date, but some foundational work is still going on. In May 2017, the board issued IFRS 17, insurance contracts. That's one of the most topical standards in the world today, which permits entity to choose whether to apply IFRS 17 and IFRS 15 to specify fixed fee service contract that meets the definition of an insurance contract. While the concept of IFRS 15 was so broad, applicable to virtually every visible or foreseeable businesses, we later still saw the need for us to be very specific, because insurance contracts or insurance business has its own peculiarity. At what point do we then determine what their revenue will be? Do you understand? So sometimes in that date, the board did work on another standard called IFRS 17. So when you now see that the conditions of IFRS 17 is applied, you should not adopt the two. It's still recognizing revenue, but on insurance business. Every insurance company is expected to adapt to this. Yeah, you can ask me any question. Yeah, so we will now talk more about under what are the cutoff points, under what circumstance can you deviate? Do you understand? Because even insurance business is also very complex. You have the general insurance, you have the actuaries and everything. It's very, very composite insurance and the like. It's very complex. It is so complex that even in our tax law, the CIT has to address specific section for insurance business. And their computation is done in a different way because of its peculiarity. Other standards have made minor consequential amendments to IFRS 15, including IFRS 16, that is on lease, issued in 2016, but the effective date was when? 2019. An amendment by reference to conceptual frameworks in IFRS standard, issued in March 2018. Are we there? In May 2014, the board issued IFRS 15, revenue from contract with customers, together with the introduction of topic C06, 606 into the Financial Accounting Standard Board Accounting Standard Codifications. So these are just various work to ensure that all the weakness and loopholes that could be envisaged in the standard is being addressed before the eventual effective date. Then, finally, IFRS 15 replaces IAS 11, IAS 18, IFRIC 13, IFRIC 15, IFRIC 18, and SIC 31. So that then means that effective 2008, all of these standards has been repealed by what? IFRS 15. Is that clear? So are we then, unlike what happened in IFRS 16, which is just a partial amendment to IAS 17, this is a total repeal. Do you understand? You remember we said that everything we discussed around IFRS 15 was all around leases and let's see what happens to the lessor. So it then still means that that part of IAS 17 is still fully operational, because IAS 17 in the lessor's book can still choose to recognize a finance lease as far as it is concerned if the conditions are met, or an operating lease. Is that clear? So I've earlier established the fact that IFRS 15 effective date is 1st of January 2018. IFRS 15 established the principle that an entity applies when reporting information around the nature. Remember I asked this question? Dash established the principle that an entity applies when reporting information about the nature, the amount, the timing, or certainty of revenue and cash flow from a contract with a customer. So what addresses that is IFRS 15. So in this context or standard, we then need to know what is the form of the contract we have with the customer. Is there an insurance contract that has been addressed by IFRS 17? Is there a construction contract? What are the terms of the contract? What are the expected promised goods or services? What is the transaction price or the contract price? What are the stages of the promised goods or services or the performance obligation? Right? Can we then objectively say, if it is a 5-stage production process, can we then say, oh, we can attach the value for stage 1, stage 2, stage 3, stage 4? What happens if we cannot actually identify what's consideration, fair consideration to each of those stages? What do we do? So all of these concerns are addressed in the standard, because depending on the nature of the contract you then have, or which your employer has with his customers, or which your client has with his own vendors, that will then inform your thinking, your review, or the audit process around reviewing the objectivity, the cutoff of that very value that have been reported as revenue. Is that clear? So it's a very interesting standard. Applying IFRS 15 An entity recognized revenue to show the transfer of promised goods or services to the customer in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. What do I mean by this? Who can explain? What I'm just trying to say here is this, that because we know that every entity here quotes certain promises to its customers, how do we recognize the consideration for that promise? So that's what I mean. Applying IFRS 15, an entity recognized revenue to show the transfer. So it is at the point that you have actually fulfilled your performance obligation. Even you know, there is a point where you could have fulfilled your performance obligation, but you still hold them some duties. How do we allocate value for the one you have discharged and the one you still hold? That is when you then have issue of warranties. Have you had those warranty option or obligation insured? Do you understand? This is common to Samsung. When you buy most of the Samsung phones, they will tell you it's under warranty, right? And if anything then happens to it, and you take it to their service center, they will just call one insurance company or the other because it has been insured. If it then had been insured, how would they have reported the revenue in their book? What happens if that warranty was not actually insured? So a lot of probability estimate, expected valuations will then need to be made, because you then need to forecast, maybe from your experience, from feedback from customers and all of that, that out of every product that have been sold, 2 of them will have fault. So you then use some probability theorems there, but I won't take you through all of that. Otherwise, you will have moved from financial reporting into business mathematics. But that concept is actually borrowed. You understand? And you remember too that we borrowed that concept when we are dealing with IFRS 16, when we have to do present valuations, trying to know the discount factor, what is the present value of this, to be able to determine what is the finance component of that insurance contract. Is that clear? I just observed that by the time you are fully baked as an accountant, you will have been a good lawyer, you will have been a good taxman. Before now, I ate law with passion. I don't want to hear. And I think the main reason is that I don't like cramming. I felt then that you can't be a good lawyer if you don't cram. But I later find out that because I spend more time in tax than even regular financial reporting, I have no other option to, most of the time, even recap some of those tax sections with ease without having cram. I can then tell you, section this in this particular act is talking about this. So most of the time when I go for tax defense, whether through tax audit and the likes, by the time I finish with my team, the team will be meeting with them, be asking, "Call, are you a lawyer or a tax?" You understand? Because not that we are doing anything so exceptional, but most people in the practice, they know what they are doing, but they don't know why they are doing what they are doing. So if you then take your practice a step further by knowing the reason for doing what, you then show your prowess. People will then be looking at you, but you are not doing anything exceptional. A lot of people they can even report revenue very well. They know how we do it. But ask them the standard of revenue, they'll be looking. They don't know. So it makes a lot of difference as an accountant when You don't only know the standard, you know why the standard proposes particular thing. What is the objective of the standard? What is it trying to seek? Do you understand? By then, you will then be able to faithfully represent the financial performance of an organization or your clients at time. Do you understand? So what then are the objectives of this standard? I did two things there. I did an extraction of what the standard expects and what I also expect that everyone that participated in this section should be able to have, right? So at the completion of this section, candidates shall be able to, one, understand the principle that an entity shall apply to report useful information to users of financial statements about the nature, amount, timing, and uncertainty of revenue and cash flow arising from a contract with a customer. Why we have a lot of problem in tax is because a lot of accountants and auditors don't make sufficient disclosures. They will just give you those figures, bam, as if they are reporting to themselves. Where they need to do a little narrations that will throw the light open for whoever or layman or a taxman that is using the report. Those information are not there. And throughout the tax people, whenever they see any deficiency, they interpret it to their advantage. So that is why this standard seek that you are not just reporting the revenue, but the nature of the revenue. That is why if you have the revenue of your client or your employer to be 10 million naira or $10 million in a particular year, don't just say $10 million in a particular year. Tell us that trading is 5 million. Rent is 2 million. Interest is this. Because each and every of that has its own peculiar function. Let me give you a typical example. A real estate company make a sales of land worth 40 million, right? One accountant disclosed it there that sales of land 40 million. The other accountant just say revenue 40 million. What do you think has been better and why? Oh, but that is not sufficient. Why? Why? What do you think that person has in mind? Why he went further to telling you that it is on land though? Because if me as a taxman comes, I will just say revenue, apply, say it's vatable. Sales of land is not a supply of service. So by saying sales of land, I'm indirectly telling the tax people, don't charge VAT on this. You understand? Or I have an interest income. I just say revenue, should be an income to us, right? Revenue, 100 million. And the other one say interest income or interest received. I can even go further to telling you interest on bonds. Do you understand? When you're doing that, you're explaining the nature. Not only for tax, we're just saying it in our own perspective now that for tax purposes, if they open our eyes the more, save us a lot of headache. If an investor has to look at it, I told you in my last class that the financial analyst in me, when you give me a financial statement, I will have to prepare it back. Because the premise on which I make my own analysis is different from what the financial accountant will look at. Do you understand? So, nature, amount, timing, and uncertainty. The uncertainty is then talking about, oh, I have revenue component of 100 million. Sorry, I keep on mentioning 100 million because I'm hoping and trusting God for 100 million. All right, uncertainty about revenue, right? If I have a revenue of 100 million then that performance obligation that I had rendered, it depended on certain occurrence beyond my control. I rendered a service that next wave of COVID will not occur. Do you understand? They paid me. The condition is that it will not occur. If it occurs, I have a liability, not revenue. Do you understand? So when you are reporting your revenue, you should then be analyzing very well. Inquire further. Are there other conditions attached to this? Otherwise, you should not disclose everything. If there are other conditions attached to it, segregate the portion that has no condition attached to it from the one that has condition attached to it. The ones that have condition attached to it should only be reclassified as revenue when those conditions are then be absolutely fulfilled. Are you with me? I would like to go back to that, my usual funny illustration. All right. If, though it's not in the regular business life, but let's just look at it. If I say that I'm married from Himo, I hope nobody's from Himo here. Okay. For the purpose of those who will listen to this in future, I'm not criticizing Himo. Do you understand? But I just cite Imo because it's one of those places in Nigeria that they have high bride price. So if the payment of the bride price, I gave the condition to the family, is that your daughter will give me a quadruplet. That amount should not be recognized as income to them until when that condition is fulfilled. You will see that those from the East, they will tell you if their wife did not give birth to a male child, their position in the house is not guaranteed. So you will see the tension, they will try again until they have a male child. So that is this kind of situation we are using to explain the uncertainty. It also applies in business. You could be the accountant of a real estate company that had constructed a building for a client. And they said that there will not be this kind of fault, not the usual wear and tear. There will not be this kind of fault in the house within the next 5 years. What they are then telling you, tell your MD or whatever not to spend the money, or we will segregate it. Because if you have fully spent the money, you use it in paying salary, and the following month or the following year, it's here. You understand? So these are, you need to, first of all, analyze every component of the revenue to be sure that there are no such conditions attached. Is that clear? This is from where? They're from where? Oh, oh. I have soft spots for the Edu. No, she's not from there, but I just like the Edu. You have a brother behind you. Oh. Yeah, you people, you always look alike now. All right, so uncertainty about revenue and cash flow arising from a contract with a customer. So then you are also expected to know the scope of the standard. What does the standard actually cover? What does it not cover? Because don't just leave this section and then say, anything income or receipt is in line with IFRS 15. No. There are some areas that are not within the scope of the standard, right? Then how do we recognize, how do we measure, how do we present, how do we disclose, and what are the transcriptional prescription of the standard, right? How do you move from the existing IAS 18 to the new one, right? Any question? So we are starting with the scope. IFRS 15 shall be applied to all contracts with customers except the following. Whenever you have any of the following, don't apply IFRS 15. Do you understand? One, lease contract within the scope of IFRS 16. So that's why you will see that when we are talking about IFRS 16, even to how the lessor will account for it, it will not be, even if you are saying it's a revenue, that your revenue was not determined in line with IFRS 15, but rather within the scope of IFRS 16. So it's not within that scope. Is that clear? So when you are also making that your disclosure, you need to be very detailed that this rental income, right of use, whatever, it is in line with IFRS 16, not 15. Is that clear? Then contracts within the scope of IFRS 17, insurance contracts. Most insurance companies around the world or within the countries that are already adopting IFRS are now expected to strictly adhere to IFRS 17. That will be a training for another day. It's as broad as IFRS 9. You're shaking your head. It's not difficult. However, an entity may choose to apply this standard to insurance contracts that have as their primary purpose the provision of service for a fixed fee in accordance with paragraph 8 of IFRS 17. So what are we now saying? Why do we say the insurance contract is an exceptional contract? Because it becomes very difficult for you to state at the beginning of the contract period that this is my fee. They don't charge you fee. Do you understand? It's just a premium. What portion of the premium is their income? It's difficult. I took an insurance policy 2 years ago for 45K, comprehensive car insurance. And a day to the end of the lapse of that contract, my car had an accident. And the total repair costs around 195K. So if they had recorded or reported 45K as income, how do you juxtapose that? Do you understand? So the star is now saying that if you have insurance engagement that say your premium is XYZ, no, my fee is this, they use IFRS 15. Do you understand? Because we can explicitly determine the revenue component. But if you have to use all those complex terminologies and all of that, average clause, blah, 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 then peg IFRS 15 and adhere strictly to the provisions as contained in IFRS 17. You might say, oh, maybe I'm not working in insurance industry. You may, whether today or tomorrow or next year, have clients that works there. And if you now say it doesn't concern me, how then do you advise them? How do you tell them the tax implication of it? How do you advise them about how to make their strategies, their policies, and overhaul their system if you don't understand how the financial report in that sector is being reported? So we all need it, right? Oftentimes, your employer may have an engagement with one insurance company and the likes, and say, Tomiwa, maybe you said you've attended this particular training. Come and speak for me. And you know, say, okay. So we need to know the concept for us in this practice, as far as we are in this space, is be prepared. because you don't know when talk around it will come up. You understand? I've been in a very messy tax situations one day that I was trying to communicate most of the tax authorities, they don't like IFRS. In fact, they are not ready to even read, at least in Nigeria. The moment you start explaining, hey, IFRS says this, everyone will say, oh, that is your business. We will work with tax law. Sure, you understand? So something then happened on their debts with another taxpayer outside my own case. I appear to have had a prior experience in that. So I now dabble into the left my own case to help them to throw more light on it. Because I was able to help them, he then listened to me that, okay, you are not just coming here to boo me. So you never can know when any knowledge you acquire. Don't just be selective that, oh, I just want to know this to this one. You don't know when the need for that other one will come up. All right, so also within the scope, remember we said anything within the scope of IFRS 16, don't even think about it. Sorry, do you need water? So anything within the scope of IFRS 17, don't think about it except there is a fixed fee. Then financial instruments and other contractual rights and obligations within the scope of IFRS 9, financial instruments. IFRS 10, consolidated financial statements. IFRS 11, joint arrangement. IAS 27, separate financial statements. And IAS 28, investments in associates and joint venture. Don't think about IFRS 15 at all. Anything that relates to all of this. Use the explicit provisions as contained in the applicable standards. You understand? Then the fourth one, non-monetary exchange between entities in the same line of business to facilitate sales to customers or potential customers. Because there will then be problem if it is non-monetary. How do you, it means a barter system. How do you determine the fair prices? However, I gave you some conditions. We'll talk about it as we go on. Okay, then that takes care of what the standard covers. Anything outside those exceptions, then IFRS 15 is applicable. So irrespective of those exceptions, its application is still very broad. So whenever you can now, or you then want to apply IFRS 15, then you must work with this recognition criteria. Have you had a contract? You need to identify the contract. What is the form of the contract? What is a contract itself? What are the things that makes a contract null and void, right? You need to look at the enforceability of that contract within the geographical territory where you're operating. There are some things that may not be enforceable in Nigeria that are enforceable elsewhere. So you need to dissect that within the purview of our substantive law or constitution in the country. What are enforceable? Sorry. Is it a good illustration to make? Okay, let me not use that. Let me use this. Even that other one will not work. If you have a gambling arrangement, gambling within the context of the substantive law in Nigeria, in Lagos in particular, it is not anti-social engagement. You now have gambling entities coming forward and all that. So it means it's legal. As long as the law allows it. If you then leave Lagos, or you leave Lagos, let's say to another remote state in Nigeria that doesn't support that, or let's say to another country that forbids gambling, it means that even though you could identify the contract, it is not enforceable. You cannot use IFRS 15. So not just, oh, I have a contract to do this. I have a contract to do this, and you are not looking at the enforceability of that very contract. Okay, let me use this. This one may then be very good. MMM. There is a contract. When you are signing up, they will give you some terms. You have to click that you accept. Is it enforceable? Otherwise, all the victims of that Ponzi scheme would have then sued who is suable because it's not enforceable. That's what you're looking at. So the accountant of MMM as an entity should then not say, I've recognized our revenue in line with IFRS 15. Do you understand? You would rather be recognizing your revenue in line with your own personal opinion. Do you understand? Then we will talk about that much more. The second condition is that you need to identify the performance obligations. The contract will have definitely split out. Lisbeth, these are your terms. Kayode, these are your terms. I will perform mine based on you having done this. Do you understand? And these are what I want to do. These are what I want to do. This is the expected output. So you need to be able to identify what are your performance obligations as an entity, what are the performance obligations of the client. At what point could you then say you have actually delivered on your promised goods or services? What are the things that could nullify that, right? Then you determine the transaction price for those performance obligations. What is the contract consideration for it? Then you allocate the transaction price to each of the performance obligations. If it is a 5-stage process, you can then say, okay, look at this. Can we all look up? Clients, most of the time, I'm talking to you as a consultant now, clients most of the time will even say, oh, I want to process tax clearance, but has not had financial record. The only thing they have is their bank statement. You will then have to tell them, okay, you need to appoint me first. If you're not careful enough, if you just tell them to appoint you as the auditor, you have to change yourself. Because there are 2 different obligations there. In fact, 3 in 1. There is a role of the financial accountant. There is a role of the auditor. There is a role of the tax consultant. So you need to be able to split it that these are the stages, right? This is the expected output. This is a consideration for each and every of them. Do you understand? This is your own role. This is my own role, right? That's what I mean by the determination of the transaction price. Then allocation of transaction price to performance obligation. Truth be told, there are some, even though you could split out the performance obligations, there will then be problem in allocating price to each of them because each of those performance obligations does not have a regulated price. So if a client engages me and says, I want to pay you 5 million to process tax clearance certificate, but I know within it, I have to prepare the financial statement. Within it, I have to get it audited. Within it, I have to do my tax computation, do the filings, apply, and adhere to other statutory disclosure before we can be talking about tax clearance, at least in Nigeria. Do you understand? What is the cost of doing the financial service? What is the cost of doing the audit service? What is the cost of doing the tax services? Do you understand? So because we've always been doing it, I already have some clients that can say what I do to them is just accounting service alone. So I can say, okay, 1 million out of that 5 million is for accounting service. Okay, because I've also had several audit clients, I can say, oh, maybe 1.5 out of the whole of the 5 million is for audit service. Then the balance is for, but what happens if I then have an engagement? Because you will not just be talking to yourself as the auditor. You have clients in fintech, you have clients in prop tech, you have clients in the digital economic space, other form outside the fintech, the prop tech, and the likes. How do you now, and they have various contractual engagements with their own customers too, which you want to report on. How do you then split? Because you are not in that space, it becomes very difficult for you to allocate the whole contract sum to each of the process. You engage somebody to build a house for you. You now analyze, you need to do this first, do the foundation, linted, this. What value do you say that, oh, if I have completed the foundation, this is the amount I should pay? I mean, I should earn. Do you understand? So the standard FE said that there are some of these performance obligations that you can objectively say, this is a consideration of the total fee. There are some, it becomes very impossible. The standard makes some propositions, we'll be talking about that. Right? Then recognition of the revenue when the performance publication is satisfied. At what point can you then say that you have actually fulfilled those performance obligations? Is it at the point when you have delivered the service to the client and the client says, no, this is not what we agreed? Or you have delivered the service to the client and the client says, oh, I'm not in the country now, I can't take it up, but don't worry, just hold it with you. I take responsibility even if anything happens to it. Or you've delivered some service to the client and that service that you actually delivered has already had some embedded warranties or additional obligations, future obligations embedded within. Let me paint a scenario. I do recruitment services. I recruited Mr. A for Tomiwa's company. He paid me a fee of, say, 250K. But in our contract, we had embedded therein that I will be responsible for the inactions of the person I seconded to him or recruited for him. What portion of that contract will particularly when we did provided a finite time. If I say whatsoever he did or did not do within 6 months, it's easier. I will wait till that 6 months is fully completed before I can recognize the revenue, Abi. Because even if you say you want to recognize some and not recognize some, how do I segregate the portion of what I've done and the portion of what I'm yet to do? But what then happens if that timeline is open-ended? It means till eternity, I will not recognize that thing as revenue. And anytime you are talking about this, let the tax implication always be coming to your mind. If you don't report it well, tax people should say, maybe they paid you the money, give us our tax portion. What if that contract has some refund condition there, that if you don't meet this condition, you refund my money and you have paid the tax? Will you now go to the government to say, refund the money? So I think you're now seeing the need for you to make detailed disclosure. Even if you say this thing is this, tell them if there are embedded conditions, split it out. Let's assume, and it can be as applicable as possible. Let's assume I'm the accountant to a company that sells spare parts. See the last rain that fell in Lagos. We are hoping that a lot of mechanics will cash out, right? And that by extension means the spare part people will sell more. Then The customer will then be wise and say, give me condition because this is not a follow come. Within this period, are you saying that this thing you are replacing will work? Do you understand? If it doesn't work, you pay me my money. So you should then in reporting, let those conditions, because it's refundable. It's a refundable deposit. You need to clear it out there. All tax obligations will be held until when that those conditions have been entirely fulfilled. But the problem then is, how would you, because you can't say you are holding it without disclosing. How should you disclose it that the tax people will reason with you? These are all the issues we are talking about. I'm sure you've not seen, as common as IFRS 15 is, I'm sure you've not looked at it in this light before. Do you understand? Because a lot of people say, it's 15. I know it's Joe. Get it. Do you understand? So, and it is a learning work in progress. You continue to learn, because what we then determines what other complex scenarios you could then have is a function of how much encounters you have then been able to. But the standard emphasizes that if you think in these lights, every foreseeable thing, at least within what they are provided now, will be captured. What they are struggling with now, there's a work in progress on, is cryptocurrency. Have you recognized the income? It's also another discussion for another day.
So, did you say you are developing a standard?
Yeah, there is a work in progress.
Oh, okay.
There is a work in progress. The disruption that COVID did too, there is a lot of work there. What FRCN only came up with during COVID is that, every accountant and auditors must then fulfill their obligations as contained in IAS 10. What is IAS 10? Tanua? You've forgotten. So when you then be talking about adjusting events, non-adjusting events, which one is adjusting, which one is non-adjusting? So FRSN just says, just because there is nothing that actually addresses that, just use the provisos of 10, but they are working on to expanding that. Because COVID, just like HIV, has come to stay. It may not go anytime soon. It came the same way HIV came. Tuberculosis, we're still battling with it till date. So it has come to stay. It will continue to disrupt the business place. We are hearing second wave, third wave, fourth wave, and all that. So it's time standards are provided to accommodate the disruption that it has caused on the business place. All right. So what is a contract? We are trying to expand we're not picking each and every of them one after the other now, right? I'm sure by the end of this session, you will have had a broader view. You will just not pick a figure and throw it on the face of the account as though, it is all the revenue. So identify the contract. How do we identify a contract? What is a contract itself? According to the standard actually defines what a contract is. Contract is an agreement between two or more parties that creates enforceable rights and obligations. So is your right enforceable? That's why we can say confidently, authoritatively, that marriage is a contract. Because if there is wahala, we can all go to court and say, Oga, we want to scatter it. This is where we start. So if it can be applied into that, what happens in the business place? The arrangement that you and I is going into, is it enforceable? If I did not discharge, can you report to the authority? If all of that, is it accommodated by the constitution of the land or the geographical area where you are? If it is, then IFRS 15 accommodates it. If it is not, throw it in the dustbin. Don't even bother asking or testing the four other recognition criteria. That is what we are saying. Do you understand? So, enforceability of the rights and obligation in a contract is a matter of the law, not the standard. The standard does not say this is what is enforceable. It only draws your attention to, if you are in Ghana, interpret that enforceability within the light or the plight of the Ghanaian constitution. Are you there? Contracts can be written, oral, or implied by entities' customary business practice. So it is not those contracts, even it is recognized that we could have some possible oral contracts. Do you understand? Do we sign any agreement when we are commencing this engagement? So it's a form of oral contract. I just discussed with you, I will take you this on this time, so and you pay me this, and we go on. Is that clear? So what I'm now saying now, that as auditors, as accountants, let it not surprise you, you go to audit a client, or you are working for an employer, and you say, where is the contract that gave rise to all this revenue? And they say, there is nothing. It's just word of mouth. Say, why? It shouldn't be. No. It could be because our law actually accommodated a form of written contract, even if it is oral, it's well welcome. Just get the committedness of the parties involved. Are we committed to being of mutual responsibility to each other for a consideration? If I then say, because this draws me back to ETS1 business law, that I'm doing what for you for no consideration, it is not enforceable. If I'm doing what for you for no consideration, it is not enforceable. It is not enforceable. So if I say, I will teach you IFRS 17 for no fee, and I didn't teach you, you can't sue me to court. Because the basic features of a contract includes that consideration. You are not giving me anything, so why are you dragging me? I say I'm not teaching you. Is it by force? Abi, madam. So you must look out for that. So when you work with them, you say, what are the obligations? Who are the parties to the contract? What are the terms? What is the form of the contract? What is Mr. A doing? What is Mr. B doing? Forget it. Some of those people will tell you, your own too much. Accountant said you started with all your wahala. You're doing your work, because this will inform the disclosures you will then give. Right?
Let me share a two life where I was working in construction. So that particular road project had been before a joint implementation. And the client, of course, was government. Yeah. And then there have been several inflows to the tune of billions in respect of that particular road contract. But there is no contract. There's no agreement. Yeah. And then there was a dialogue with the auditor as to why should we take this as a revenue. MD insisted it has to go to revenue because we want to boost the fund so that the product will be, and they will be able to get more contracts. So auditor is saying you can't take it as a revenue because there is no contract. How do you identify the contract? So I asked this question based on what you said, that sometimes there may not be documents. In that case, what do you do from the perspective of the auditor and the in-house accountant?
Okay, we encounter a lot of that in practice. We encounter a lot of that. And because of the peculiarity of this, our environment, ordinarily you will say that that issue of oral, what passes as oral contract, and the threshold involved should be a function of the materiality test. If something is more material, there should be documentation for it. But in Nigeria, we know how it plays. A lot of things go without documentation for it. And truly and honestly, there may not be documentation for it. So what I will then do as the auditor is that you said this thing, I must be able to see where is the inflow coming from. One, what in response as part of your orally disseminated obligation to me, what are the things you have been doing? Can I see evidence that this thing is actually not there? The reservation auditors we have is that they want to be able to clear that court that is not money laundering. Do you understand? So if I can have that soft land, and what I will use to determine is that, okay, you said you have 100 billion for contract. They've paid you all or part materially. What have you been doing with it? Have you started doing anything about it? If you have not started, and I cannot see any trace of you having initiated that very process, I will not totally say it is not a revenue, but I will wholly defy it or report it as a contract liability. Do you understand? Because you have not earned that revenue. It's a receipt to you, but you have not earned the revenue. If I then have any further doubt of the origin of that revenue, then I will do circularization or circularize the party. If the party is not accessible for me to circularize, then I will tell you as my own comfort, your lawyers definitely will have known about something very solid. I'll get a comfort letter from the lawyer. If the lawyer says, oh, I don't know anything about it, yeah, then you are the person involved, give me a representation letter affirming that this thing is genuinely so. Do you understand? With those comforts, I will exonerate myself. Do you understand? I will exonerate myself because don't forget in audits, particularly external audits, you don't give an absolute assurance. There could be some element of not totally normative. Do you understand? So, but you should just try as much as possible to hedge the risk of you reaching a wrong opinion. So, and if I have those comfort, of course, I will recognize the inflow, but not as revenue if you have not shown something materially to show that, oh, I've collected this money, but this is what I'm doing, which is the expectation as output or promised service or goods for the contractee. So I will not totally jettison it, but I may not report it as revenue if it still does not pass my test. It will not be included in turnover. For it to be totally included in turnover, don't forget I have to look at the time when I am actually reporting. Is it when IAS 18 is applicable or when IFRS 15 is applicable? If I must report anything in line with either of those standards, I need to fulfill the recognition criteria of those. If you can tell me that, oh, we have a project to build, take me to the site you've been seeing building, what scenario? I will tell you then that when it then becomes difficult for you to recognize or allocate transaction price to each of the performance obligations, the standard proposed two methods, right? The output method and the input method. You understand? The output method will then be what fee would you have charged for that stage of the work? If I can objectively get a value for it, good. If something has been going on, get a value or whatever to do the estimation and we get an objective assessment for it. But if it becomes impossible for us to get that, then I will look at your own costs to it. That is the input method. How much have you invested that I can see the work going on. I will take audit evidence of all of that. And you have given me, oh, out of that 100 billion, we spend like 30 billion on this. I will recognize to the tune of that 30 billion as your revenue, then defer as contract liability the balance. Do you understand? So that's what the standards. Anything outside all of that, then you're on your own. You are neither applying the standards. But trust me, most of those businesses, particularly those who are intending to achieve a self-motivated objective, we say, oh, it's everything that should be there. Everything can never be there. If everything should be there, then you must have fully discharged your obligation. Do you understand? Then there will have been a constant and satisfactory note from the supposed customer, even if you have not done anything, and I get a satisfactory note from the supposed contractee that I'm fine, then I will report it. I'm fine, and there is no future litigation against you. So ask a question. Okay. Okay. Yeah, look at it. When we say, I will be explaining that when we get to recognize revenue, when the performance obligation is satisfied. Yeah, but the customer satisfaction will be there. Don't forget, we said contracts are enforceable. Enforceability then means that that client will then go to court and say, I'm not agreeing with this is not what we agree. So it then means that your performance obligation, when there is a dispute, it means either parties, either you are the one wrong or the client is the one wrong. Somebody is wrong. So in the word of the standard puts it that the customer has not taken control of that supposed assets. Because what we are doing, the service we are rendering to the client may most likely qualify as an asset, whether as a non-current asset or as a current asset or anything. Do you understand? So in decision criteria, when we get there, you will then see that satisfaction is being interpreted to meaning the customer taking control of it. We went further when I was introducing it to expatiating on whether there is warranty. If you have not fulfilled the warranty period, which could be very much synonymous to the fact that, whether implied or unimplied, you have given certain comforts to the customer. And if the customer expressed that discomfort, that man, you have not done what I expect you to do, you cannot totally report this as an income. That is why also we as auditors, when we go to audit in field, we then circularize the lawyers, whether there are pending cases against the company in courts. These are part of the things we're looking for. The company secretary will then tell us, we have one case, so we did 7 jobs in that year, but 2 of them, customer did not were not satisfied. We are still on it in courts. Possibly among the terms of those reference that we want them to respond to, we tell them to also project what could be the likely implication of this. Is this something that will result in contingent liability that we have to disclose? What is the impact of that contingent liability? Is this something that will strengthen the going concern of the company? We then have to be considering qualifying the account or point that out in the key audit matters in the opinion page of the auditors. Do you understand? So there are ways that as the financial accountant, not all of these things are under your control. You know why? The employer then can harass you. I will sack you if you are becoming too difficult. Do you understand? Because I remember when I was handling an accounting role so many years at the beginning of my career, I know I used to, coincidentally,